This is the story of Dan Moran. Dan is a student loan victim. Dan is 36 and a production editor at ATS Journals in Waterbury, Vermont. He will be represented by a koala. Dan attended 4 years of college and 3 years of graduate school. Each year, he borrowed the maximum amount in loans. The maximum amount increased each year he attended school. Dan was financing his education with some savings, grants, and lots of loans. After 7 years of school, Dan had overwhelming grants and loans. The more he borrowed in loans, the less he received in grants. Dan was making minimum payments and not covering his interest rates, increasing his debt every single month. Upon entering the job market, Dan had to take a series of blue-collar jobs just to pay his bills. After 15 years, the interest rates have caused his $40,000 in debt to increase to $60,000 in debt. Every week, Dan earns $500, but every month he has to pay $400 in loan payments. $39 of that is in interest. Because Dan reconsolidated with U.S. Department of Education before the historically low interest rates of the late 90s, he couldn't reconsolidate with everyone else. Furthermore, Dan can't file for bankruptcy. People with gambling and credit card debt can file for bankruptcy, but not those with student loans. Dan has been with his girlfriend for 8 years, and they own a home together, but they can't marry because, in the case of student loans, the borrower's spouse's income would be counted with theirs, and Dan's minimum monthly payments would increase to $800 a month. With fair student loan practices, Dan would have a much brighter financial future and more peace of mind.
Hi, I'm Joan Lynch. I previously worked for Meritor Savings Bank, where I was a department head, and I managed several different groups, including the student loan department. The first thing I would tell a prospective client about applying for student loans is to go to your university or college and talk to the financial aid department. Many of the colleges and universities have relationships with banks and other lending institutions that can help you through the process and sometimes provide you with a discount in the rate or points that they charge on student loans. Students should be very careful when they're dealing with different institutions. They should avoid any loans where they're not being given a chance to look at all the terms and conditions for the loan, meaning how long the loan is for, what are the fees up front, what interest rate is being charged, and how the loan is being paid back. And even if they can pay back the loan before the end of the date, or it's called a prepayment. What I would suggest is that you talk to several different institutions and definitely read the terms and conditions. I would avoid any loans where there are very high fees up front, or if the terms and conditions are so cloudy or not available to you that you would feel uncomfortable signing the loan. Well, one of the things that will happen is the fees up front that you pay will be very large. For instance, if you're borrowing $20,000, they may be charging several points or percentage points up front on that loan. A lot of times you start to pay the loan back and you think you're paying a $20,000 loan back, but because they've charged you a lot of points, maybe you're paying a $22,000, $23,000